Hi, guys. Welcome to the How I Raise It podcast, the show where you get an inside look at how real founders raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Astrid Atkinson of Camus, a climate tech startup building software for the electrical grid. We talk about the unique challenges of raising money for a clean tech startup, how she brought investors along on her customer discovery journey, learnings from her long career at Google, and much more. If you're tuning into this podcast to learn how to raise capital for your business, I've created a super valuable free welcome package for you. It includes a list of 2,500 investors who don't require a warm intro, plus 200 questions that investors are going to ask you. It's really going to help you get ready to raise money. To get instant access, please click the link in the first comment. While you're there, give us a like, leave us a nice comment, what you like about this episode or this series in general. And last but not least, if you enjoy this conversation, think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Astrid.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Astrid Atkinson of Camus coming to us from the Santa Cruz Mountains region. How are you? How's your day going?
It's going pretty well.
Good. Excellent. Well, let's go straight into it. What is Camus?
So Camus is a software company that focuses on software for electric utilities. Specifically with the intention of supporting utilities that are going through the process of changing how they manage their electric grid to support greater amounts of decarbonization. So we build software for utilities.
So what's thinking about building software for utilities sounds like a Herculean effort, right? I think of utilities as old, slow moving, stodgy, probably risk averse, so on and so forth. So how'd you get to this point? What's the backstory?
Yeah, so my background is building extremely big systems. I started at Google. I was there for about 15 years. And my role at Google early on was first in the team that launched Google's internal cloud platform that runs basically all of Google's business today. Then in their site reliability engineering team for about 7 years. So it's the team that's kind of a hybrid engineering operations team, which really sort of focuses on how you build distributed systems at scale. And I was an early lead in that team. I ran the on-call team responsible for building and operating Google's global web serving layer. So I carried a pager for google.com myself for about 5 years. Had a lot of experience at Google in building very, very large software infrastructure systems, particularly ones that had very high reliability requirements, and which were effectively making a platform for everybody else to do business on. Last team I led up there was Google's internal microservices frameworks team. And a lot of what we did there was build services that we then moved every public facing product at Google to use. So I had a lot of experience with both building very reliable distributed systems and also moving large, kind of highly sensitive, multi-billion-dollar products onto them.
Yeah.
And in parallel, I had a developing interest in transitioning into the energy and climate space and figuring out basically how do I use what I'm great at, which is building really big systems and software teams, to solve the problems I care about the most, which is decarbonization and helping us move to clean sources of clean energy.
Excellent. Good job on that. We need more of people like you. So it's encouraging to see, what you guys are doing. Try and describe this in a simple, try and describe what it actually does, what the software does in a simple way as possible. I had a business school professor said, explain it to me like you would explain it to my 7-year-old kid or my 85-year-old grandma. Yeah. I'm reading the website. I only get, part of it. So maybe take a crack at dumbing it down for us.
Yeah. So there's really two main things that we do. One is gather together all of the sources of data about how the grid works. So this is information from like substations and smart meters and solar panels and things like that. And then on top of that, we provide some services which include a dashboard so you can see it and see what it's up to. And then the ability to control devices that can contribute to operating the grid. So that's typically batteries, solar panels, EV charging, smart thermostats, all these kinds of things.
Okay, got it. And with the, if I'm understanding this correctly, the ultimate outcome is reducing carbon and stuff like that. How does it sort of help utilities get to that outcome?
Yeah. So the model for managing grids up until now is very one way. So basically, sort of on one side is all the consumers using energy. And then on the other side is a few big power plants where you turn it up and down based on how much demand there is out there on the customer side. Customers are very dumb in that model. They don't do anything. But as we move towards sources of generation that we can't control as directly, they generate when the wind blows or the sun shines. We need more tools to control demand, and we need more tools basically to get power from the time and place where it's produced to the time and place where it's needed. So a lot of that is about demand around on the customer side. And a lot of that is also just about using our existing grid, our network differently. So equipping grid operators with the tools that they need to understand how to use that network differently in this new, more two-way model is kind of the core problem that we're tackling. But a lot of that looks like a distributed systems problem. It's basically like, what's it doing? That's not actually something that grid operators had a really good handle on, at least at the consumer edges of the grid until very recently, and some still don't. It's why when your power goes out, you call up the utility. A lot of times they're like, oh, thank you for letting us know, instead of like, oh, we already knew about that and we are fixing it now. Because they actually have up until quite recently, and for many now, have very, very, very little visibility into what's actually happening on their grid at any given moment. Whereas coming in from like the software and internet side, having a real-time monitoring system that tells you what's the state of the network, what's the state of service, what's the state of your endpoints, what tools do I have available to solve problems? That's a kind of foundational requirement in the kind of internet system space.
All right, a couple more questions about the business, and we'll get into fundraising for it. But how did you came from Google, you had this deep software development, enterprise scale software development background. How do you go do, customer discovery and create? How do you figure out what utilities need? How do you do that sort of customer learning and research? That seems like that would be daunting.
I was interested in moving generally into the energy and climate space. And so I started a fairly systematic investigation probably 6 or 7 years before leaving Google. I started to basically kind of initially ask that question of basically where are my skills useful in energy and climate? And once I got interested in grid management as sort of a core problem in that space, I then spent probably about 5 years researching it. I talked to people. I reached out through my professional and personal networks, basically anyone I could find who had ever worked in the space. I was like, who should I talk to? Can you introduce me to them? I probably had hundreds of conversations with people during that time, as well as, of course, you can read books and papers and the internet and listen to podcasts and all of those sorts of helpful things. But that process of reaching out and talking to people was really important. It helped us kind of understand that fit between the technical skills that I and my team could bring in versus what was really needed in the field.
And then last question on the business, how about selling to utilities? How do you crack in and get your foot in the door with utilities and sell something like this?
Utilities are a legendarily difficult customer segment. They're very conservative. Their job is to keep the lights on. They care about that the most. In general, their business model is also not very friendly to the kinds of work that we do. Most investor-owned utilities make money on a regulated rate of return on capital investment, which means that when they build new equipment, they get basically like 10% of the cost of that back in profit. So they're not natively really set up to benefit from things like using less energy, or even building less grid. And so, it's hard to sell, not because of culture, but because of business model reasons. So that was a known factor going in. And so part of what we had to do, even before starting the company, was think about ways to engage in the utility space that could be commercially viable, perhaps do better than some of the companies that had come before us. And so that was part of that. It was actually a really big part of the research process for us, was thinking about business models that could be successful in the utility space. I can talk about that a little bit if you'd like.
Yeah, maybe. Yeah, sure. What is the business model? I think
so we're a software as a service provider. That in and of itself is a bit unusual in the utility space, because up until about 3 or 4 years ago, utilities were very anti-cloud. But anyone who's working in the cloud and SaaS space knows that there are some things you can't do unless you can computers to do them. And really processing very large amounts of data in real time, solving very complex problems in real time. Those are needed for managing the grid in the world we're moving into. And so just coming in as a cloud native company actually made a big difference to us. The other thing that was really helpful to us was identifying that there are different segments within the utility space. And most of the kind of traditional hurdles apply to the very large investor-owned utilities that are the top 150 or so. If you just look at the US market, it's actually about 3,000 utilities in the US, though. The other 2,850 are all publicly owned nonprofits that are typically owned by communities or cities. And selling to them is actually rather different, and in some ways a lot easier than selling to the traditional utility market. So, part of this was about thinking about our business model and what we could bring that was differentiated, and part of that is kind of the cloud and SaaS model. The other part of it was identifying a go-to-market segment that was potentially viable, and that is in fact where we started.
Okay. Sorry, where you started is the locally owned utilities?
That's right.
Yeah. Got it.
We work primarily with public sector utilities today.
Got it. Interesting. Cool. When did you guys start? How long have you been working on this? I know you did a lot of research, but when was the actual company formed?
Yeah, so we formed the company in early 2019. So it's probably about 5 years of research for me. And then the company is just over 3 years old now.
Okay, great. All right, let's talk about raising money for this. So you
Sure.
leave Google, you decide, all right, I'm going to go do this. Was it hard to leave Google? I mean, 15 years, I think you said 15 years there. That's a long time.
It was very hard to leave Google. I actually loved working for Google. And while it had its complexities and its struggles, as any job in any large company will, I was really happy there. And also I was really well paid. So walking away from that was really difficult.
Plus free lunch. I mean, free food. It's pretty amazing.
I worked at Google for so long that I'd come to take the free lunch for granted. And for a while, actually going out and paying for lunch was kind of a fun novelty. But I liked the work a lot, and I was very successful there. So it was a big decision to leave. Some things that kind of tipped the balance for me. The climate problem is very urgent, and I'd come to believe that it was really important that we have technical solutions that were viable in the grid decarbonization space within the next 10 years. I have a son who's 9 now. And it's going to sound like a cliche, but for me, at least, that kind of changed my sense of responsibility towards getting involved in the problems I cared about the most. That was a motivating factor for me. The other was that I'd gotten increasingly excited about working in the grid space and had connected with some people who were interested in co-founding with me, including one of longtime Google colleagues. Cody, our CTO, was actually my first office mate at Google. I've known him a very long time. And by the time he left, he was one of Google's most senior systems engineers. He was one of the 3 people who was kind of overseeing their entire site reliability practice and technical work. So he came very well qualified as well. Our other co-founder, Michael, was actually my husband's favorite ex-boss. He's got more of an enterprise and IT background. And he was the person who, when I was kind of asking myself, like, look, I'm thinking about starting a company. Who do I know who has an MBA and won't mind me asking dumb questions? I thought, Michael will not mind me asking dumb questions. And that was actually really important for me in going through the process of understanding what it would actually take to start a company.
Good. So did you guys, let's talk about fundraising now. How'd you get it off the ground? Did you go raise money from Google Angels? There's a lot of those out there. Self-finance, what?
So when I was thinking about starting the company, I started talking with investors. They were, among my kind of research groups. And what I heard from basically all the friendly investors that I talked to was, wow, it's really hard to start a company that's utility facing. Are you sure you want to do that? Even all the way up to like Astrid, do literally anything else. Like I would write you a $3 million check today for any other company. Which was, it's something that I factored in. But the conversation I started to have with those potential investors was like, okay, well, let's talk about what a viable company in this could look like. And that was very helpful because it helped us to think about, the details of our business model, our go-to-market strategy, all of these things. One of the people that I had had a set of those early conversations with was Abe Yokel at Congruent. Congruent later ended up joining our friends and family round and then co-leading our seed and following us through the A, and they've been really good partners. So that early process of kind of enlisting investors to help us think about how to build a company that is fundable and potentially viable, couldn't recommend more. It worked very well for us.
Maybe let's dig into that just a little bit. So yeah. Maybe even, I don't know, unpack that a little bit. Like you're going to strangers like that are investors in the clean tech space and saying, here, I have this thesis. Can I kind of run it by you, know, or what?
So I had network in the investor community. In particular, one of my former mentors at Google is a partner at Sequoia, someone I respect highly and have been consulting for advice for many years, well in advance of starting a company. Sequoia at the time didn't invest in clean tech at all. And they were basically like, no, like, I love you, but no. Mm-hmm. But I also was sort of reaching out through my network to let people know, basically, like, look, I'm thinking about starting a company in this space. Do you know anyone? And someone that I knew through Google's venture, their growth venture arm, Capital G, introduced me to two people that he knew who were clean tech investors and had been for a long time. One of them didn't answer my email. The other was Abe.
Mm-hmm. At Congruent.
So that like kind of loose network connection that I sort of was proactively looking for was very helpful in basically getting warm intros to people who would have those conversations with me.
Okay, let's talk about kind of turning that research process into actually getting the people to write a check. Did you just one day say, all right, I've completed my research, now it's time to actually cut me a check?
Yeah. No, absolutely not. So what we started doing was chatting with potential investors. And at that theme of like, okay, I'm not going to fund a company sight unseen in this space at all. But if you come back with a customer, I would consider it, was very, very clear early on. So I heard that many times from venture investors. I was like, okay, I'll come back with a customer. But I need money to get started so we can go get a customer. And so at that point, I had friends and family who had been kind of offering to invest, including, like, honestly, when I was leaving Google, some of my ex-reports were like, hey, can I invest in your company? And at first I was like, no, I'm going to go to venture investors who have lots of money and make them give it to me. But after having that set of initial venture conversations, I thought about basically what our options were and also who I wanted on the team. And having those ex-colleagues and other kind of key people from Google on the team, as well as people who were very supportive of what we were trying to do, was very appealing at that point. Because these were really, a lot of them were people that I was interested in pulling into the company later. And also who would be really good sources of engineers with particular sets that we would later want to bring into the company. And also, frankly, I really had reached a point where I had reasonable conviction in the business model, and I was willing to kind of, take that on the road with people that I knew. So, again, we sort of reached out, myself and my co-founders, through our network. Basically went back to people who had offered in the past and told them, yes, actually, we'd be willing to potentially take money. So we raised just a little bit over $1 million on a friends and family round, in check sizes ranging between 25,000 and 100,000. And that was mostly from either former coworkers or folks through that network.
Yeah, interesting. That's interesting that you're kind of viewing them as, a 25K check, but also potential engineering, recruiting, help down the road. I think that's strategic.
Of those people, I think 2 work for the company now. One is on our board. That did end up, creating an extended team that was really helpful later.
Yeah, cool. Were these people that friends and family rounds we haven't actually talked about on this show very much, so I'm going to dig into that just a tiny bit more. Were these people angel investors already, or was this their first investment? And how do you sort of manage or message that hey, you're probably going to lose money, or kind of that risk level with friends and family? Yeah.
Some of them were angel investors already. Most were not. And that was originally why I told them no. Actually, I was like, look, you're a friend. I don't want to take your money and potentially just lose it. Most companies fail. And I'd rather honestly work with people who have experience in losing money, or at least putting it into startups that might. When I went back to them, I was pretty firm about trying to make sure that I had informed consent, and talking them through sort of the normal life cycle of startups, what the risk profile looked like, those kinds of things. But in general, they were pretty excited about potentially funding companies in the space that we were in. So companies doing work in climate, but also companies that were taking the specific kind of big system software approach that we were taking, and the team that we had put together. So it was a bit of team and a bit of mission that was really driving that.
Cool. So you take that $1 million, you go out, I'm assuming, get a customer or 2, and then go back to VCs. Let's kind of fast forward to
so we actually only got about 850K through that before Congruent came back, and we're like, hey, actually, we would be interested in joining the round. Do you guys have room? Prior to that, early in the friends and family process, we had actually had a conversation with another seed investor who did offer us a $650,000 check. That was an AI focused fund. And after really thinking about it and kind of looking at what they were looking for in terms of their engagement and their thesis, we actually kind of made the difficult decision to say no to that, primarily because we weren't going to be doing any AI. Very short term, although it is part of our focus going forward. We're doing a fair bit of ML now, but I'm kind of picky about usage of AI and ML as technology bases. And we really were years away from doing any of that. So it's like, wow, I don't know if I'll ever see another check like this, but I don't think I can take your money. So it was a pretty difficult decision. But when we got the offer to join our friends and family round from Congruent, that was a better fit in terms of thesis. They looked to back companies like ours. They were now excited about working with us. And we basically were joking. We're basically like, you guys are family now. And they kind of have been in practice. They've been very supportive, and they closed out the round.
Got it. I like that. The importance of kind of fit with their thesis. I think that's important. Yeah. Just to avoid sort of that misalignment down the road, right?
Yeah.
Yeah. Good. Okay, good. And then what else? You've raised another 1 or 2 rounds? 1 round.
So not too long, actually, after closing the friends and family round, we had closed our first 2 customers, and we went out to go raise a seed round. Congruent's friends and family check came with a side letter that basically stated, we would like to have the option to lead your seed round when the time comes, which is the sort of side letter that you're excited to accept, frankly. I was like, oh no, twist my arm. And this is kind of what I meant by them being very supportive. So at the point where we had closed our second customer, we decided we were ready to go out and raise our seed round to grow the team. And at that point, Congruent co-led that with another investment group, Wave Capital. that is mostly backed by ex-Airbnb people. So they're more
What's it called again?
Wave.
Wave Capital. Okay. Right.
Wave invests in companies with a market component to their business model. And we do have a volumetric pricing and markets component to our business model, somewhat in a forward-looking way, but that is where we want to get to in terms of managing kind of flows of energy.
Did you only talk to a handful of investors? It sounds like this was fairly linear, or from Congruent to Wave, or did you get out and shop it around a little?
We shopped it around a little. Throughout this period of time, I was getting intros to other investors through friends and family, through Congruent and others. And I was having background conversations with potential investors. At the point where we decided that we were going to start the seed round, we started to work actually with Congruent on putting together a plan for raising that. But almost immediately, I had several offers for potential leads. We sort of stopped that formal process almost before we started, because we knew we wanted Congruent involved, and Wave also wanted to lead. So they ended up co-leading, and that was our seed round. So that was very straightforward.
Got it. Okay. And does that bring us up to, I believe there's also a
we went through our Series A last year, so I can talk about that. That was a very different story if you want to hear it.
Please, yes. Yeah, tell us that story.
Yeah, so last year we raised our Series A. We started that process early in the year, so that kicked off in kind of January, February timeframe. It was very different from our seed round and quite a bit harder. We were a bit over a year and a little bit past closing our seed, and the A was a lot more rigorous in terms of process. So I can talk a little bit about that if
please.
Want to go through the story.
Yes, please.
So as we had done with our seed, we actually sat down and did some planning with our existing investors to figure out who we wanted to approach, what kind of round we wanted to raise, what composition we were looking for. We knew we wanted a mix of clean tech and tech investors. And we went through and sort of put together a list of potential candidates. I think it started at probably 40 and ended up over 80 for folks that either Congruent or Wave recommended, or otherwise fit our investor profile through research that we had also done. That also included folks that we had spoken to in the past, including people like Sequoia and Union Square, as well as people who Congruent often work with as follow-ons, because Congruent, especially at that time, was primarily seed focused and didn't go through to doing lead at the Series A level. So typically they would feed onto other funds. So we put that list together and started the process. And this is the point at which we had to decide if we were going to go like kind of fast or slow. And there's basically sort of two paths for us. One would be to like try with a few funds and sort of see how that did and refine our pitch. The other was to go ahead and try to do a more traditional raise, in which we talked to potentially dozens of funds within a short period of time, and look to kind of find enough excitement amongst that larger group to get to a term sheet and get it, sort of have multiple candidates interested. At that point, we had a couple of big name firms, including Sequoia and Union Square, pretty interested. So we decided to go ahead with the talk to everybody at once plan. In hindsight, I regret that. It wasn't the right strategy for us. And I think it was a perfectly valid path to take at the time. Because what I found as soon as we started doing the kind of talk to everybody at once process was that, especially in the tech space, where that is kind of the recommended methodology, as opposed to clean tech, which can be a little different, most firms really weren't ready to commit to funding anything that was utility facing or really clean tech, especially at the time. A lot of firms were ramping up their interest in the clean tech space, but they hadn't yet done a lot of research. And what we started to hear over and over was, I don't think we can commit on your time frame. we'd really need to do a lot more internal research before we could form our own thesis about this. And that kind of meant two things. It meant partly what it said, but it also meant this is a scary space where there hasn't been a good track record of success yet. We don't have enough independent conviction to be the first people into it. So this is not enough of a slam dunk that we're comfortable moving forward on a short time frame. And so that became a theme very quickly within like a couple weeks. And at that point, it was clear that we were going to need to potentially change our tactics a little bit. And so that was sort of the point at which it was clear that that was going to be less of a quick, like, okay, we're going to go out and just raise a bunch of money, and more of a slow, like, we're going to need to be really thoughtful about this.
So what did you change tactic wise? I mean, other than kind of slowing down, I guess, a little bit, but yeah.
So there were a couple of things that we changed. One was that we really came back to our story and did another round on our pitch deck. And we changed it pretty substantially to sort of focus less on the formulaic, like kind of nuts and bolts, here's your template Series A deck of the things that we've done so far and the things that we'll do next, and to focus a lot more on narrative and storytelling. That always would have been good advice, to be honest, but it was hard to tell what story was going to resonate the most with investors until we went through the process of pitching with a whole bunch of them. So I was sort of rapidly refining that, but in retrospect, I would have done better making it a little slower and doing that refinement process more deliberately. So that was definitely one thing. The other was that we started to shift focus away from the more of the like enterprise SaaS type funds, which is kind of what we were originally targeting, and more towards the clean tech type funds that were interested in and experienced with funding in clean tech generally and grid businesses specifically.
Yeah, that's good. You know, I don't know, I'm not an expert on this by any means, but didn't a lot of the larger funds kind of get burned in clean tech, like circa mid 2000s, early 2000s? I don't know what.
Absolutely. So when I was first talking with Bill, who is my mentor over at Sequoia, that was part of the conversation. And that was where he was sort of like, Astrid, this is going to be really hard. Because he was sort of giving me the backstory on Kleiner and John Doerr's experience at Kleiner, which was very negative in the 2008 bust. And I heard that from a lot of other tech funds early on, including people we had really good network connections through. So for example, like Cody worked pretty closely with someone who's an investment partner at Kleiner when he worked on the healthcare.gov rescue project. They knew each other very, very well. And this was another one of those conversations where it was like, look, if you guys were starting a different kind of business, we would be so excited to back you. But you're starting this one, so we're going to need a lot more proof, was kind of the message there. And I think it really just came down to while many more companies were setting up funds to fund climate type ventures in the tech space, that was still very early days for them, and they were not really ready to like jump straight in yet, and they still aren't, honestly.
Did you? I know I was a little bit tempted by this when I was raising money. You get these different ideas from investors, like, if you were this, we'd be interested. Did you ever get sort of almost lured away to building something else? I mean,
yeah, I got a lot of feedback from investors of various sorts. If you were this, we would be more interested. Like if you started a different sort of company, we'd be more interested. Yeah. If you change your focus in the following ways, we'd be more interested. I think there's a really important balance between having an informed thesis for the company that you're trying to build, that you have conviction in, versus taking reasonable feedback from people who know what they're doing. And so what I tried to do is really focus on the big sort of aligned themes. And some of the big aligned themes when we were raising our seed, for example, were like come back with one customer. Then when we had one customer, what we started to hear was come back with two customers. When we did come back with two customers, though, we raised our seed very quickly. So that was eventually true. It just wasn't specifically true. Some things that I heard in the A round were come back with more commercial traction, come back with an investor-owned utility deal that's much larger. During the process of raising that round, we actually did get to kind of verbal yes on some larger commercial deals. That wasn't actually enough to get the investors to yes, though.
Mm.
Part of that is the difference between like a verbally committed deal versus a signed contract. But part of it's also that it wasn't strictly about linear progress. It was also more about like coming back with the kind of proof points that would help get them over the hump towards really feeling like we could build $1 billion business in our space. And I think it's really important just for founders just to factor in that a lot of times the feedback that you get, even when it's consistent, is sort of spiritually true, but perhaps not specifically true.
Mm. That's really interesting. Explain that a little bit, like, or maybe, yeah, just clarify that a little bit. I think that's interesting.
The difference between feedback that's sort of spiritually true or thematically true versus specifically true is really that difference between what investors are willing to tell you would change their mind, such as more commercial traction or one more customer or a deal that's 10 times larger or something like that, versus what they're really asking for, which usually is more confidence in some risk dimension that they're not comfortable with. What we were hearing was like, we love the team. We're interested in the product. We are really concerned about the market. And so what was spiritually true about that feedback was we're really concerned about the market and we need more proof points to help us build conviction that there's a business there. And I understood that when we were getting that feedback, and spent some time chatting with our advisors, our board members, our existing investors about both ways that we could tell our story better, but also ways that we could continue to build confidence in commercial proof points and reduce commercial risk. And so some of that was coming back with more and bigger deals. Some of that was also really just finding investors that were bullish on the space that we were moving into, actually. Because some of that was just about the difference between like, I'm interested in what you're doing, but I feel kind of anxious about whether it could be successful, versus I've independently researched this space. I'm really bullish on the space, and I think you guys are a good bet in it. And it was investors in the latter category that ended up being the right fit for us. And so that's also a reason why going a little slower helped us, because what we were looking for was investors that already were excited about the area that we were in so that we could come and fit into their story about it.
Yeah. People who've listened to the show for a while have heard me say this before, but one of the quotes I learned from some other guest on the show that I just love is that fundraising is not about convincing people or winning them over, but it's the search for believers, finding the people who already have a belief in this space and this thesis, that have done their research, like you said, and kind of have a belief that you're matching with. And I thought that was kind of epiphanal for me when I heard it. I love that. So it's kind of, yeah.
I couldn't agree with that more. For me, this is, an extension of some past lessons, learned in my earlier phases of my career. They say that you should always pick the boss that you work for sooner than the role that you're in. Or at least I've heard that advice. And I wholeheartedly believe it at the point, having done the opposite a couple of times. I've certainly had roles in my past career where I was excited about, the opportunity, but didn't necessarily click with the people I was working for. And that always was really difficult over time because I was always selling to my boss about my work, about me, about my team, the work we were doing. Whereas when I worked for bosses who were independently excited about, me, my team, what we were doing, all of these things, it was a really positive experience. And so, I knew that when we were looking for investors, effectively, when you're finding your lead investor, especially, you are choosing your bosses. They're going to be on your board. They're going to represent the interests of your investors. And it's really helpful if the people who are going to be on your board really believe in your company and want to help it be successful. If you have to be selling to them that things are actually like good and okay every time you have a conversation with them, that's just much harder to be successful with.
Really good stuff. I won't keep you much longer. What kind of a two-part question or same question asked two different ways. What advice would you give your younger self if you were fundraising all over again that we haven't covered, or any other just general advice for raising capital for a clean tech business? Any other specifics, tactics that you'd like to share with fellow clean tech founders?
I think that advice about finding the investors who are going to be independently excited about the space that you're working in, and focusing on building relationships with them was probably the most important thing I learned during the A round. I would definitely, if I were going to do it again, I would really be focusing earlier on finding those people who are super excited about our space and building relationships with them well ahead of the raise. So that's something that I definitely have carried with me. As we're not raising our B yet in a while, but it's definitely something that I've carried with me as I start to think about doing that. So that's one piece. The other thing is that clean tech right now, I feel, is in a similar situation to med tech or gov tech from probably like 5 or 10 years ago now. Hadn't been sufficient standout successes of people building really great businesses in the space, that it was easy to get investors who were excited about it. That's changed after some strong proof points came along. So there was for any of those spaces, there's a few companies that are really kind of showing that there can be success in that sector and showing what that might look like. That doesn't mean you can't build
it's like
companies.
It's sort of heating up a little bit more, or because of yeah.
I think interest is heating up quite a lot more. I think that we still have yet to see this most recent round of companies generate those like standout successes that get investors really excited.
Yeah, interesting. Good, excellent. All right. Anything else that we haven't covered? We've covered a lot, I think.
The last thing that I just wanted to mention, with regard to our A, we did end up with lead offers from a few different venture investors. The thing that actually really changed it for us, though, was that in the meantime, we had started to have a really, really great conversation with a potential customer who was so excited about working with us that they offered to invest.
Oh.
They were actually the first one in with a term sheet. That made a huge difference to us. Both the fact that like someone had come in wanting to be the lead and really kind of get over the hump of like, oh, I'm interested, but I don't want to lead. And also it was a really powerful proof point for us with other investors that we had a potential customer that was so excited about working with us. So that was really huge for us. And I don't know that it's something you can necessarily like draw recommendations from, but I wanted to highlight and also, acknowledge that because it really made a difference for us in getting the round closed in time.
Who was that?
The other thing,
can you disclose or?
That was PPL. Actually have their hard.
Oh, sure. Yeah.
Here, Pennsylvania Power and Light.
Okay.
They're an East Coast utility with actually a really solid track record of partnering in large scale tech deployment. And I am very excited to be working with them.
Does that, I'll let you go, I promise, I keep saying that, but does taking money from a strategic investor like Pennsylvania Power and Light make it easier to get into other utilities because it's like a validation, or are they competitive? Do other utilities like, oh, you're aligned with PPL, like we don't really want to work with you. You know what I'm saying?
No, they're not competitive because they're regional monopolies.
Right.
In general. So it does actually help us a lot. One of our considerations was trying to make sure that we had basically sort of a kind of balanced investor syndicate. PPL was really helpful in working with us and putting that together. Our eventual actual lead was a financial investor, Park West, who are primarily a hedge fund. Getting that group together that was excited to be working together as well as working with us was really the thing that kind of pulled it together on the A for us. Excellent.
All right. If people want to learn more about Camus, but it's spelled Camus.energy, correct? Or how should people find you?
The company's name is Camus. We're named for the French philosopher. And I'm happy to have a longer conversation about why if folks want to hit me up. The web address is camus.energy. energy. And that'll get you to us.
Cool. Great. Anything else you want to, sometimes I'd say anything you want to plug or give a shout out. I guess you're probably not going to find too many customers listening to this show, but anything else you want to promote or plug, open job rec or anything?
We're definitely hiring. We have actually hired most of our outstanding engineering recs, but we do have some roles that we're hiring for. They're on our website. So if you're interested in working with us, please come drop us a line.
Excellent. All right. Well, Astrid, thank you so much. This is really interesting. Founder Street has a little partnership with Los Angeles CLEANTECH Incubator, which is an accelerator for clean tech startups. I'm going to definitely send them this episode to circulate. So, keep an eye out for you. Yeah.
We actually did go through Lacey's program.
So you did? Oh, I didn't know that. Wonderful.
Yeah. Even though we're not LA based.
Lovely. Great. All right. Thank you very much. Have a good day. Keep doing what you're doing. We need it for my kids as well as your kid.
Thank you so much. I really appreciate
it. Okay. Over now.
Have a great day yourself.
Bye.